Let's begin. Number 10. The goldsmith's sneaky side hustle. Imagine your money is so lazy, its life goal is to just sit there. That's basically what money used to do. Back in the 17th century, you didn't have a savings account with a fancy app. You had a sack of gold coins that was a magnet for every thief within a 50-mile radius. So you'd take your heavy, shiny, very stealable assets to the local goldsmith. He had the best security system of the era, a big, heavy vault and a guy with a pointy stick standing guard. You'd hand over your gold and he'd give you a piece of paper, a receipt, that said, "Yep, Dave's gold is in here." Soon everyone was doing it. And a funny thing happened. Instead of trading clunky gold coins, people started trading the paper receipts. Why bother lugging metal around when this little IOU from the goldsmith worked just as well? The goldsmith, who wasn't an idiot, noticed something crucial. People rarely came back for their actual gold. The paper was the new gold. So a devious little thought sparked in his brain. What if he wrote out a few extra receipts? Receipts for gold that didn't actually exist in his vault. He could lend these fake gold receipts to people who needed loans and charge them interest. It was the perfect crime. He was lending out your money, and money he didn't even have, and getting paid for it. This wasn't a bug in the system. It was the birth of the entire system. The finance lesson here is that the value of money is based on collective trust, not necessarily on physical stuff locked in a vault. The moment people believed the paper was as good as the goldsmith could create money from nothing but ink and confidence. This little side hustle wasn't just some historical quirk. It became the blueprint for every bank you've ever walked into. They took this scheme, polished it up, gave it a fancy name, fractional reserve banking, and built the global economy on it. Turns out, the most powerful financial tool in history started as a surprisingly simple grift. Number 9. The government-sanctioned magic show. So, the goldsmiths proved you could run a profitable business by lending out other people's money. It was sketchy, unregulated, and prone to blowing up spectacularly. But governments, especially the British Crown, looked at this chaotic system and didn't see danger. They saw an opportunity. In 1694, the Bank of England was founded, and it essentially took the goldsmith's back alley magic trick and put it on the main stage. This wasn't just a bank, it was a state-sponsored money printing machine that ran on debt. The government needed cash to fund its endless wars with France, and this new banking model was the answer. Here's how the magic trick got supercharged. The government set a reserve requirement. This is a rule that says for every deposit you take in, you only need to keep a fraction, say 10%, on hand. The other 90%? You can lend that out. Let's play this out. You deposit $1,000 in the bank. The bank keeps $100 in its vault and lends out the other $900 to your neighbor who wants to start a doomed alpaca knitting business. Now here's the crazy part. That $900 loan gets deposited into your neighbor's bank account. His bank now sees that $900 deposit, keeps 10%, 90, and lends out the remaining $810. This process repeats over and over again. Your initial $1,000 deposit has magically created thousands of dollars of new money in the economy. The financial lesson is the money multiplier effect. It's the engine of economic growth, allowing capital to be created and allocated to new projects, businesses, and mortgages. But it's also a system built on a promise that can't possibly be kept. If everyone who was created in this chain tried to withdraw their cash at the same time, the whole illusion would shatter. The Bank of England didn't just create a bank. It created a system where money was no longer a finite resource, but an expanding bubble of credit, sanctioned and protected by the most powerful institution in the country. They didn't just approve of the trick, they made it the law of the land. Number 8, your money's worst nightmare. What happens when the magic trick is exposed? You get a bank run. It's the financial equivalent of yelling fire in a crowded theater. except the theater is the economy, and the fire is the sudden, terrifying realization that your money isn't actually there. Once fractional reserve banking became standard practice throughout the 18th and 19th centuries, these panics became a recurring feature of life. All it took was a rumor, a bad harvest, a failed business, a war on the horizon, and the spell of confidence would break. People would remember that the bank only held a tiny fraction of everyone's deposits. Suddenly, your calm, rational neighbors turn into a frantic mob, all rushing to the bank at once to demand their physical cash. And this is a mathematical nightmare for the bank. They lent out 90% of their deposits. They cannot pay everyone back. The first few people in line get their money, the rest get a locked door and a polite notice explaining that their life savings have vanished into a vortex of bad loans and broken promises. During the American banking panics of the late 19th and early 20th centuries, this was a common occurrence. Before the establishment of the Federal Reserve in 1913, the U.S. had no central bank to act as a lender of last resort. If a bank was in trouble, it was on its own. The lesson? The entire fractional reserve system is balanced on a knife's edge of pure psychology. It works perfectly as long as everyone remains calm and believes it works. But the moment that belief wavers, the system devours itself. A bank run is a self-fulfilling prophecy. The fear of the bank failing is the very thing that causes it to fail. It's a brutal demonstration that the money in your account is just an entry in a ledger, a digital ghost backed by a promise. And as history shows, those promises are only as strong as the mob's mood on any given Tuesday. Number 7, the financial fire department. After decades of watching the economy suffer from spontaneous combustion every 10 to 15 years, the U.S. government decided it needed a fire department for money. This wasn't just any fire department. It was a supreme, all-powerful institution that could, in theory, stop any bank fire from spreading. In 1913, they created the Federal Reserve. The Fed was designed to be the ultimate backstop, the lender of last resort. The idea was simple. If a single bank started to wobble and a bank run began, the Fed could swoop in and flood it with emergency loans, calming the public and restoring confidence before the panic went viral. It was the government's attempt to professionalize the money creation scheme. Then, after the system still collapsed during the Great Depression, they added another layer of protection in 1933, the FDIC, or Federal Deposit Insurance Corporation. This was the masterstroke of psychological manipulation. The government made you a direct promise. Even if your bank completely implodes, even if it makes the dumbest loans in human history and goes belly up, we, the government, will personally pay you back up to a certain limit. This insurance fundamentally changed the game. Why would you panic and run to the bank if your money was guaranteed by the full faith and credit of the United States? It was like putting a sprinkler system in every room of the theater and giving everyone a fireproof suit. The lesson here is about managing systemic risk, or at least the perception of it. The Fed and the FDIC were created not to eliminate the inherent instability of fractional reserve banking, but to manage the mass psychology that makes it so dangerous. They didn't fix the flaw that your money isn't really there. They just made the promise that it would be there so convincing that you'd never feel the need to check. The system became less about banks managing their own risk and more about a centralized authority promising to bail everyone out if, or more accurately, when, things go wrong. It's a much bigger, much more complex magic trick. Number 6, when the whole system crashes. So, the Federal Reserve was created in 1913 to be the great stabilizer. Its prime directive was to prevent the very kind of catastrophic banking collapse that had plagued the nation for a century. Then came October 1929. The stock market crashed, and the real-world test of this new fire department began. It failed, miserably. The Great Depression wasn't just a stock market event. It was the most devastating, widespread banking crisis in modern history. Between 1930 and 1933, over 9,000 banks in the United States failed. This wasn't just a few poorly managed institutions going under. This was a systemic implosion. Nearly a third of all banks in the country vanished. Imagine waking up to find your bank, the solid marble-columned building on Main Street, is just an empty building with a note on the door. Your life savings, your business's payroll, your parents' retirement, all gone, wiped out. This wasn't a digital number disappearing from a screen. This was the tangible loss of people's futures. The Fed, in the eyes of many economists like Milton Friedman, made the situation catastrophically worse. Instead of injecting money into the system to stop the bleeding, it allowed the money supply to contract by a third. They had the fire hose in their hands but stood by and watched the inferno spread, arguing about the proper way to hold it. The horrifying lesson of the Great Depression is that even a central bank cannot stop a total collapse of faith. The psychological panic was too big, the economic hole too deep. The system of fractional reserves, designed to multiply wealth in good times, proved to be a powerful engine for multiplying poverty in bad times. Each bank failure triggered others in a domino effect of terror. The system that was supposed to create prosperity out of thin air was now creating destitution with brutal efficiency. It was the ultimate stress test, and the financial architecture of the entire Western world buckled under the pressure. Number 5. Snipping the golden leash. For most of history, money had an anchor, however tenuous. The goldsmith's receipt was backed by gold. The early Bank of England notes were theoretically convertible to gold. Even after the creation of the Fed, the US dollar was tied to gold on the international stage. Foreign governments could, in theory, show up with a pile of US dollars and demand a pile of gold in return. This was called the Bretton Woods system, established in 1944, and it acted as a sort of leash on the money creation machine. A country couldn't just print infinite money because it had to maintain enough gold to back its currency's value. But by the late 1960s, the US had been printing a lot of money to fund the Vietnam War and massive social programs. Other countries got nervous and started asking for their gold. The US gold reserves were draining away at an alarming rate. So on August 15, 1971, President Richard Nixon went on television and did the financial equivalent of flipping the table over. In what's now known as the Nixon shock, he unilaterally announced that the U.S. would no longer convert dollars to gold. The leash was snipped, the anchor was cut loose. In that moment, the entire global financial system was fundamentally and permanently changed. The U.S. dollar, and by extension most world currencies, became pure fiat money. What does fiat mean? It means money that has value simply because a government decrees that it does. It is backed by nothing physical. No gold, no silver, nothing. It is backed only by trust in the stability of the government and the strength of the economy. The goldsmith's trick was now complete. We had reached the final level of abstraction. The paper receipt is no longer a claim on gold. It's a claim on nothing more than other paper receipts. This move gave governments and central banks unprecedented power to expand the money supply, with no physical constraints to hold them back. It was either a brilliant move to create a more flexible, modern economy, or the most reckless financial gamble in human history. The jury is still out. Number 4. Playing God with interest rates. Now that money is a government-backed fantasy with no golden anchor, who's flying the plane? That job falls to the high priests of finance at the world's central banks, like the Federal Reserve. Their primary tool for controlling the economy isn't a magic wand, but something almost as powerful, the federal funds rate. This is, in the simplest terms, the interest rate at which banks lend to each other overnight. By raising or lowering this single rate, the Fed attempts to steer the entire multi-trillion-dollar global economy. It's like trying to control the weather for a continent by adjusting a single thermostat in a basement office in Washington, D.C. When the economy is sluggish, the Fed lowers interest rates. This makes borrowing cheaper for everyone. Businesses are encouraged to take out loans to expand. You're encouraged to get a mortgage or a car loan, and the river of newly created digital money flows faster, hopefully stimulating growth. When the economy gets too hot and inflation starts to rise, meaning the money they're creating is losing its value, they raise interest rates. Borrowing becomes more expensive, the flow of new money slows to a trickle, and the economy hopefully cools down. This constant fiddling creates the boom and bust cycles we've all come to know and love. The dot-com bubble of the late 90s and the housing bubble of the mid-2000s were both fueled by periods of artificially low interest rates. The financial lesson is that central planning for money has consequences. In theory, a small committee of brilliant economists can perfectly guide the economy between the rocks of recession and the whirlpool of inflation. In practice, they are always reacting to old data, and their actions often create the very instability they are trying to prevent. They inflate massive bubbles by making money too cheap for too long, and then to fight the inflation they helped create, they have to hike rates, which often pops the bubble and crashes the economy. It's a cycle of controlled chaos, all stemming from the belief that they can perfect a system built on an illusion. Number 3, the 2008 meltdown. The trick gets too big. For decades after World War II, the system of government-backed, centrally managed money creation seemed to work. But in the early 2000s, the trick went into overdrive. Fueled by rock-bottom interest rates set by the Fed, banks began creating money on an unprecedented scale, primarily by writing mortgages. They gave loans to anyone with a pulse, bundled these risky mortgages together into complex financial products called mortgage-backed securities, and sold them to investors around the world. The fractional reserve system was running wild, building a global pyramid of debt on a foundation of shaky American real estate. Then, in 2008, the foundation crumbled. Homeowners started defaulting on their loans, and the securities built on top of them were revealed to be worthless. The problem was, every major financial institution owned vast quantities of this toxic garbage. The trust that holds the entire system together evaporated overnight. Banks stopped lending to each other. The credit that acts as the economy's lifeblood froze solid. This was the bank run on a global institutional scale. The entire system was hours away from a complete, catastrophic failure, a new Great Depression. But this time there was a new rule: too big to fail. The government and the Fed decided that institutions like Bear Stearns, AIG, and the major banks were so intertwined with the system that their collapse would bring everything down. So they initiated the largest bailout in human history. The promise made by the FDIC was extended to the entire financial industry. The lesson was brutal and clear. In the modern fractional reserve system, profits are privatized, but losses are socialized. The lesson was brutal and clear. In the modern fractional reserve system, profits are privatized, but losses are socialized. Banks get to keep the winnings from the magic trick, but when the trick goes horribly wrong, you, the taxpayer, are forced to cover the losses to keep the show from ending. The system didn't just survive, it was rewarded for its catastrophic failure. Number 2, the era of free money. What do you do after the biggest financial crisis in 80 years caused by too much easy debt almost destroys the world? If you're a central bank, you double down and make debt even easier. In the aftermath of the 2008 crisis, the Federal Reserve and other central banks embarked on the most radical monetary experiment in history. First, they dropped interest rates to zero. For over a decade, the price of borrowing money was essentially free, at least at the highest levels. This was meant to encourage lending and stimulate the economy, but it also inflated massive bubbles in stocks, real estate, and basically any asset you can think of. But 0% interest rates weren't enough, so they unleashed a new, even weirder tool, quantitative easing, or QE. Try to follow this. The central bank, with its infinite ability to create money, digitally prints billions of dollars. It then uses this newly created money to buy assets, like government bonds and those toxic mortgage-backed securities, directly from the commercial banks. This pumps the banking system full of fresh reserves, which in theory, they can then lend out. Between 2008 and the COVID-19 pandemic, the Fed's balance sheet exploded from less than $1 trillion to over $8 trillion. They were creating money not just to facilitate loans, but to directly prop up asset prices and inject liquidity into the financial plumbing. This is the goldsmith's trick in its final God mode form. We have moved from lending out deposits to lending out fiat currency to a central bank creating trillions of dollars from nothing to buy debt and keep the system from seizing up. The lesson of the post-2008 world is that our economy has become addicted to this constant creation of free money. Any attempt to turn off the spigot, to raise interest rates, or shrink the balance sheet causes the markets to panic. The system is now so fragile that it seemingly cannot function without a permanent fire hose of newly created currency, making you wonder what happens when the next real fire starts. Number 1, the inescapable consequence. So where does this all lead? You take a goldsmith's clever trick, let government supercharge it, remove its golden anchor, and then hook the entire global economy on a permanent IV drip of centrally planned, digitally created credit. You get the world we live in now. The ultimate consequence of the fractional reserve system, especially in its modern fiat form, is inflation and debt. Every dollar created by a bank when it makes a loan devalues every other dollar already in existence. Your savings, your wages, the cash under your mattress, they all lose a tiny bit of their purchasing power. For decades, this process was slow and mostly hidden. But after the massive money creation following 2008, and the even more massive response to the 2020 pandemic, the consequences came home to roost in the form of the highest inflation seen in 40 years. Simultaneously, the system incentivizes debt on every level. Governments can fund their spending not just through taxes, but by issuing bonds that are often bought by their own central banks, a bizarre, circular process of a government borrowing money from itself. Corporations borrow cheap money to buy back their own stock, artificially inflating their share prices. And individuals are encouraged to take on mortgages and credit card debt to maintain their standard of living as the value of their cash erodes. And individuals are encouraged to take on mortgages and credit card debt to maintain their standard of living as the value of their cash erodes. The entire world is now saturated with debt at a level never before seen in peacetime. The final inescapable lesson is that there is no free lunch. Creating money from nothing is not magic, it is a trick. It's a way of pulling future prosperity into the present, but at the cost of currency devaluation and ever-increasing levels of debt. The system allows for incredible economic growth and innovation, but it is inherently unstable and creates a treadmill effect where everyone has to run faster just to stay in the same place. The goldsmith's sneaky side hustle has become the operating system for the entire planet, and it's running on a promise that gets mathematically harder to keep every single day. Basically, your bank account is an IOU from a magician who's really good at making promises. Subscribe before he runs out of rabbits.